Hello, my name is Alvin Mongura, and today I want to talk to you about the fundamentals of running a business. In the course of my consulting work, I get a lot of people asking me this question. Business people, entrepreneurs, they ask me, Alvin, where do I get money to run my business? Today I'm going to be talking about that. Where do you begin to look for money when you're running your business? So allow me to talk to you about two fundamental statements: the profit and loss account and the balance sheet. You see, as a business person, many a times we get to tell the business what to do. We have a product, we have a service, and we use the business as a tool to get revenue from the marketplace. So in other words, we talk to the business. As a business owner, you're always talking to your business. The question is, do you have a mechanism for the business to talk back to you? How are you getting feedback? In any relationship, there are always two sides to communicating. If you're the one always doing the communication, if you're the one who's always talking and talking and talking, the other party of the conversation will suffer. It's the same with businesses. If all you do is tell the business what you want, how you want it, and you don't allow the business to give you feedback, something in your business will suffer. So today I'm going to talk about that. How do you begin to communicate with your business? How do you begin to raise money from your business? Let's look at the profit and loss account. The profit and loss account, which we sometimes refer to as the income statement. This is a statement that answers the question, is my business making money? This is the best statement for me. I love this statement because it answers the fundamental of every business. Is my business making money? Let's look at the first part of the profit and loss account. Sales. I call this your first class financier. If you're a business person or an entrepreneur and you're looking for money, the first place you look for money is from your customers. These are your first class financiers. They fund your business. If you don't have customers, you don't have a business. So who are your customers? Your customers are a bunch of people who are willing and compelled to buy your goods and services at the price that you have determined. They are happy to buy it at the price that you have determined. And these are not your relatives and your friends. There are a group of people outside there in the marketplace who are happy to consume what you're selling at the price you have determined. This is your first class financier. And your role as a business person is to quickly identify who these people are and begin to serve them. As you begin to serve them, then your market begins to grow. Let's look at the cost of sales. These are the people you must pay in order for you to make sales. In other words, if you don't pay this group of people, your ability to make another sale is compromised. They're very, very important for your business. Now, your direct costs or your cost of sales will vary from business to business. And therefore, you don't have a blanket and one-off category of cost of sales or direct costs. These will vary from business to business. So if, for example, you are a consultant and your customers come to you, then rent becomes a direct cost. If you're in manufacturing and you have labor, you have electricity, and you use water in order for you to manufacture a product, those become your direct costs. If you're in entertainment, for example, and you're a singer, then your studio costs become your direct costs, because these are expenses that are directly connected to sales, and you must pay these suppliers. Once you have paid this bunch of suppliers, what you're left with is what we call your gross profit. Now, your gross profit is your second-class financier. Sales minus your direct costs, you get gross profit. This is the second place where you get money from. In order for you to grow your gross profit, you need to increase your sales or reduce your direct costs. That's how you grow your gross profit. Now, I want to talk about a very important thing right about now. I've talked about sales and I've talked about direct costs to produce gross profit. Your sales minus your direct costs that generate gross profit, that is what we call your business model. That is the reason why you went into business. And so it's very, very important for you as a business owner to learn and know how to measure your business model. Is your business model working or is it not working? How do you begin to understand and communicate with your business to know whether your business model is working or not? You look at your gross profit. I want to talk about the third class financier, produced by expenses that you incur in order to support your business model. I call this the ETCs of business. These expenses do not directly affect your sales in any way. However, they do support your business model. These are your administrative expenses, your systems. These are expenses that are connected to the growth of your business model. In other words, these expenses are indirectly connected to your sales. One of the biggest mistakes that entrepreneurs do is they put a lot of focus in administrative expenses. Now, remember, the administrative expenses do not produce sales. And therefore, if you put too much attention on these administrative expenses, then they rob you of your money that goes into building your business model. So your administrative expenses are your financial system, your people system, and your operation system. As your business model begins to grow, your business will automatically place a demand for you to invest in the administrative expenses. And therefore, as a business owner, especially if you're starting out, your first 5 years should be focused on proving your concept, which is building your business model. Your energy, your money, your mind should all be focused on your business model and not your administrative model. So once you have paid your administrative expenses, then you get your third-class financier. After your third-class financier, you have a provision for tax. You have to pay tax. And after tax, you have what we call net profit, which is your fourth-class financier. Now, ladies and gentlemen, your fourth-class financier is your money as a business owner. Something they never told you about running a business is that as a business owner, you are at the bottom of the food chain. Once you've paid everyone else, you pay yourself as the fourth-class financier. Here's where you buy your car. Here's where you buy land from. Here's where you take a vacation from. It's your fourth-class financier. You see, what I've observed people doing in business is they begin to pay themselves before they have paid the direct costs or even before they've paid the administrative expenses. Once they have made a sale, and if it's a good sale for that matter, many business owners begin to pay themselves from sales. You go and buy that land, you go and buy that brand new car, you go and buy yourself a property, a rental property, or you take yourself on holiday. And you forget or you neglect to pay your direct costs or your administrative expenses. What happens if you don't pay your direct costs? It means your ability to make sales in the following month is compromised. If your market really loves what you're selling and you have to produce again, then the only next best option for you to finance direct costs is through debt. And once you get into the cycle of wrong debt, you go down a slippery slope that is very difficult to come out, especially when you're running a business. So let me talk about the balance sheet. The balance sheet is a statement that answers the question, do I have the good assets that my business needs in order for me to generate income? Do I have the right quality assets? That is what the balance sheet communicates to the business owner. You see, an asset is anything that puts money into the bank account. An asset will either increase your sales or reduce your expenses, either direct expenses or administrative expenses. That's what an asset is. So as a business owner, your job is not to look at an asset the way an accountant does or the way your auditor does. You're not an accountant, you are a decision maker. And so your balance sheet needs to be a tool for decision making and not just a document to present it for tax purposes or to the bank. And therefore, the way you begin to view assets and the way you begin to view liabilities is very different from the way your accountant or your auditor or your taxman looks at an asset or a liability. A piece of property, land, that is sitting in your balance sheet, that is not generating income for your business, might be deemed a liability in your eyes as a business owner. A loan can be categorized as an asset in your eyes if this loan helped you acquire an asset that doubled your income or cut your expenses by half. And so when you look at your balance sheet, you're looking at the quality of the items in your balance sheet with regards to either increasing income or reducing expenses. In other words, the assets that I have and the liabilities that I have in my balance sheet, are they increasing my net profit? Are they increasing my fourth class financier? And so as a business owner, you should be able to determine the impact of your assets and your liabilities in relation to net profit. So a liability is anything that reduces your income and increases your expenses. Let me talk about your cash flow. I have this mantra that says, turnover is insanity, profit is vanity, cash flow is reality. Now you see, when you make a sale, it's considered an income even if you have not collected it. When you have received an invoice from your supplier, it is considered an expense even if you have not paid it. It's possible for you to sell and sell a lot on credit without collecting. And that's why I say turnover, your sales, is insanity. If you go beating your chest, you made 20 million in sales, and you have not collected that amount of money, that's insanity. Your profit is made up from sales minus your expenses. And you have seen, once you receive an invoice from your supplier, it's considered an obligation to pay. And therefore your profit can be made up of sales that you have not collected and expenses that you have not paid. And therefore your profit is vanity. The amount of money that is sitting in your bank account, that is your reality. Because that amount of money gives you the power to run your business. So business people need to be very careful when it comes to sales, especially on credit, and expenses that they incur also on credit. Because the power to run and execute your decisions is held by your bank account. So let's look at the balance sheet as we can see it here. In the month of February, you can see they've made a sale of 1.5 million. And the same month, they've made a profit of 406,000. That means they have grown from January to February. Let's look at the balance sheet. Cash in the bank account. That's where your power is. In the month of January, despite a profit of 108,000, they only had 10,000 in the bank account. In the month of February, where they made a profit of 406,000, they had an overdraft of 500,000, which means they've gone into debt. It's very possible for you to have good sales, good profit, and bad cash flow. Your cash flow determines the success of your business. And so while you're making sales and having market activations, and while you're measuring your expenses and you're being economical, you're being effective, you're being efficient to produce a high net profit, while you're doing all that, which is the right thing to do, one eye must always be on your cash flow. Are you collecting from your customers? Because if you don't have money, you can have a very, very good and profitable business that ends up dying within 5 years because of the lack of cash flow. You see, ladies and gentlemen, reading financial statements is a fundamental skill for every business owner. You don't have another alternative when it comes to running a business but to know how to read and understand your financial statements. This is how your business talks back to you. This is how you begin to collect feedback from your business. This is how you maintain a good relationship between you, the business owner, and your business. It's impossible for you to make smart choices as a business owner if you can't read and understand your profit and loss account and your balance sheet. These are the fundamentals of running a business. The day you decided, I'm going to be an entrepreneur, I'm going to be a businessman, this is the environment that you decided to run into. That's it, folks. I hope this lesson has been helpful. If you want any clarification, any more information about what you've talked about today, please see the email below and I'll be happy to hear from you. Thank you and have a good day.